Hi, I'm Realtor Bert today. Welcome to another edition of a video series I like to call Sipping Coffee or Tea with Realtor Bert today. And basically, this is going to be an educational series, and this topic is a very interesting one. This topic is actually going to be 4 videos, and it's for mortgaging and mortgages and financing. We've already had a couple of videos. The first one focused on types of mortgages, and the second one is how to get approved for a mortgage. Now, the third one is interesting because it's going to be understanding interest rates and their impact. This is a really interesting topic. Why? Because I have a mortgage calculator app that I like to use, that I'm studying rates all the time on my phone on a daily basis for clients, and the overall impact of those rates, right? So we find ourselves, we're in 2024, and we find ourselves in a very interesting and challenging interest rate environment. Okay, so rates have gone up considerably. They're probably in the sevens now, right? And compared to what they were, say a few years back, during the pandemic years, we saw 2 point something, 3 point something, fours, that kind of thing, and now seven something, and people are saying, "Oh my gosh, what's going on here?" And it has impacted the real estate industry considerably, and it slowed things down certainly. But that was what the Fed was after, right? Whenever they started to raise rates, and remember, they don't raise mortgage interest rates. They raise the overnight funds rate, which tends to impact more the interest rate on car loans, variable rate loans, credit cards, things of that nature. However, because everything's in lockstep, you find that the mortgage interest rates are affected commensurate with that. It's also based on the 10-year Treasury bill, but I mean it's a deeper discussion. Today, I wanted to talk to you about the interest rates, and so when I go looking between the interest rates and so forth on my app, I'll find that there are the differences over a 30-year period. So we're going to talk about the 30-year fixed in just a minute. Wow, what a difference it makes, right? Over the life of the loan, the tens of thousands of dollars difference in interest rates. If you can afford, or you have good enough credit, you can afford a little bit more of a down payment for a conventional loan, and you can afford the monthly payment for a 15-year mortgage, what a difference. The amount of interest that you save is just tremendous. Anyway, let's get into understanding interest rates. There's fixed versus adjustable rates, right? So the fixed rate mortgages, of course, are the interest rate where it remains the same for the entire loan term, providing stable and predictable payments. We've talked about this in a previous video. And those are typically going to be 15, as I just mentioned, 20 and 30 years, right? Remember, the longer the term, the more you're going to pay in interest. Plain and simple. Now, the adjustable rate mortgages, or the ARMs as they call them, this interest rate can change periodically, leading to fluctuating payments that can be lower initially, but they can increase over time. Now, I think I told you a story in a previous video about Steve, a mortgage loan originator, right? A salesman, basically, right? He was trying to sell me on the ARMs back in 2001 when I bought my first house. And this guy was insistent, "Oh, but the adjustable rate mortgage is such a great product and whatever." And I was like, well, if I don't know what realistically what my payment's going to be, next month or the month after or next year, then it's really not for me, right? I'm not much of a gambler. If I go to Vegas, which is, I think I've been once in the past 20 something years, it's to watch shows. I think that I went to watch shows with my family, and that was about it. I didn't gamble. I just don't participate. No judgment to those of us that do gamble, but I just don't do that. So why would I want to gamble on what my interest rate's going to be on my mortgage, and how much my monthly payment's going to be? And that's how we got into this mess. Subsequent to Steve's, selling me that loan product, I ended up going with a conventional loan, fixed interest rate, and but I still remember he was trying to push that arm on me. He really was, that adjustable rate mortgage, and that's what caused the problem 7 years later, during the housing crisis, because so many people, their rates did go up, and it was beyond what they could afford. If they had a $1,200 payment and it went up to $2,000 or $2,200, I mean that's an extra $800 to $1,000 a month. That's almost double what the payment was, and that's what was happening across America. People were just saying, I'm underwater. I'll just leave the house. Here are the keys, and we'll see you later. Who cares what happens to my credit? And millions of people did that, and it caused a real problem for us. Now, the second thing I want to say about this topic is the factors influencing interest rates. So we can talk about economic conditions such as inflation, unemployment rates, economic growth. They can all impact interest rates. Federal Reserve policy, we just talked about that, right? That for example, last month, they for the first time since I don't know, 2021, they lowered rates 50 basis points, which is 0.5%. They're meeting this week, in fact, and from the recording of this video, and they're supposed to cut rates again 25 basis points, so 0.25%. That's 0.75%. Is that really going to change the rates, the mortgage interest rates, much? Well, so far, based on the last 45 days, it has not changed that 0.5%. Actually, the rates went up, believe it or not. I have some buyers that are really frustrated right now with that, but that's the way the cookie crumbles, as they say, right? But the Federal Reserve's decision on monetary policy and the federal funds rate the overnight funds rate that we just talked about, can affect mortgage rates as well, right? Just as we mentioned. Now, credit scores. Borrowers with higher credit scores are typically going to receive lower interest rates. So those that have lower credit scores because they haven't been, for whatever reason, they have lower credit scores, they're going to pay higher interest rates, even though they could probably ill afford to. But that's what's going to happen, right? That's just how it works. So the loan type and the term is also going to drive this, right? So the different loan types, again, fixed mortgage, an ARM, right? An adjustable mortgage rate, adjustable rate mortgage, an FHA and a VA loan, and the different terms, the term loan terms, 15 years versus 20 years versus 30 years, they have varying interest rates based on that. And the reason why I said if you can afford the higher payment, go with a 15-year mortgage. Not only are you going to save on interest, but you're going to get over the course of time, but you're also going to lower your interest rate. You're going to get a better interest rate. It's going to behoove you to do so. So the impact on monthly payments is another thing to consider, right? When we're talking about factors influencing interest rates, because those higher the impact on monthly payments is that their higher interest rates are going to increase monthly mortgage payments and the total cost of the loan over its lifetime. You got to think of long term, right? It's not a short-term game. It's a long-term game. Long-term game is what I'm trying to say. Over the course of time, right, of the life of the loan, it's going to be a lot more money over time. Lower interest rates can reduce, obviously, monthly payments and the overall cost, making homeownership more affordable. And remember, you can always put more to principal. You just be sure to let if you want to make an extra payment on your mortgage, that's fine too. I recommend it. I think it's a great thing to do. Just make sure that your loan servicer or your bank, whoever you have your mortgage with, knows where you want to put that money, and you want to put on the principal, not on the interest. Okay, you don't want to pay down the interest. You want to pay down the principal, so it's less interest over the long term. Long-term financial impact is the next thing I want to talk about, which is a difference of even a small percentage in interest rates, right, can result in significant savings or costs over the life of the mortgage, right? That's what we've been talking about in this video. So choosing the right interest rate and the loan type based on your financial situation and long-term goals is crucial to your success in obtaining financing. So that's the video. Thanks for watching. We feel that by understanding these aspects of financing and mortgages in this video series, is what we're talking about. This is video number 3 of 4. We feel that potential home buyers as well as homeowners can make better informed decisions that best suit their financial goals and, of course, their needs. So this has been another video in our educational series that I call Sipping Coffee or Tea with Realtor Bert today. Hopefully you found this video interesting. Be sure to like and subscribe this video, share it with your friends, leave a comment below, and would love to answer any questions you might have, so feel free to reach out to me. 210-376-TALK is my phone number. Feel free to ask any question about real estate. I'm here to help. That's why I film these videos, to help the public. 210-376-TALK. Hope you've enjoyed this video. Thanks for watching. I'm Realtor Bert Tade, broker owner of Santino Properties LLC.